Here's a question almost nobody asks correctly. If you had zero investments right now, and you were starting completely fresh next year, what would you actually do first? Most people think the answer is a stock pick. It's not. The people who build real wealth from nothing follow a specific order of operations, and skipping steps is exactly why so many beginners either never start or start and quit within a year. So let's go through it in the right order. The order that actually works, not the order that gets clicks. Before you touch a single stock, there's a question you have to answer honestly, and most beginners never do. Is investing even the right move for you right now? Here's why that matters. Let's say you put $10,000 into the market, and it grows at a solid 10% this year. That's $1,000 of new wealth. Feels great. But if you're also carrying $10,000 of credit card debt at 25% interest, you owe $2,500 in interest that same year. Net result, you're down $1,500, even though your investment worked. You didn't lose because the market failed you. You lost because you solved the wrong problem first. So step 1 isn't opening a brokerage account. It's this. If you're carrying high-interest debt above roughly 10%, pay that down before you invest a single dollar. That debt is a guaranteed, mathematically certain negative return. No index fund promises anything close to guaranteed. Step 2. Before you invest, build a cash cushion. 3 to 6 months of expenses, sitting somewhere boring and accessible, not in the market. Here's the failure mode this prevents. Say your car breaks down, or you lose your job for 2 months. If you don't have cash set aside, you're forced to either put it on a credit card, which puts you right back in step 1's problem, or you're forced to sell your investments to cover it, possibly at a loss, at the worst possible time. The cushion isn't about earning a return. It's about never being forced to sell. Once those 2 boxes are checked, now we get to the actual investing. And this is where most beginners make their first real mistake. They think successful investing means finding the next big winner, picking the company that's about to take off. Here's the problem with that idea, and it's bigger than most people realize. Go back and look at which companies dominated the market by decade. The names at the top in the 1980s aren't the same names that dominated in the 2000s, and those aren't the same names dominating today. Being the biggest company in the world has never been a permanent status. It's a rotating seat, which means betting your entire strategy on correctly guessing who sits in that seat for the next 20 years is a bet most people lose, including professionals who do this full-time. So if picking individual winners isn't the move, what is? This is where a simple idea solves a genuinely hard problem. Instead of betting on one company, you own a small slice of hundreds of them at once. That's what an index fund does. You're not trying to guess which company wins. You're betting that the economy, as a whole, keeps growing over time. A much safer bet than picking a single name. And here's the part that makes this genuinely powerful. Not just safe, how your money actually grows once it's invested. There are 2 separate engines running here. The first is simple. When the businesses you own become more valuable, your slice becomes more valuable too. The second engine is the one people underestimate, and it's called compounding. Your money doesn't just earn a return once, it earns a return, and then next year, it earns a return on that return too. Early on, this looks unremarkable, small dollar amounts on small dollar amounts. But stretch that same process across quiet, unremarkable years, and the shape of it changes completely. The growth in the later years dwarfs the growth in the early years, not because the percentage changed, but because the base it's compounding on kept getting bigger. This is precisely why the years you're invested matter more than almost any other factor you control. Which raises the obvious next question, how much money does this actually take? Less than most people assume. You don't need a windfall to start. What actually determines your outcome is a mix of 3 things: how much you consistently put in, how long you leave it invested, and whether you avoid the 2 costly mistakes we're about to cover. There's no minimum threshold that unlocks investing. There's only the decision to start with what you have and treat it as a habit, not a one-time event. Now here's mistake number 1. And it's the single most common way beginners sabotage their own returns: panic selling. Markets don't move in a straight line. They drop, sometimes hard. And when that happens, the emotional reaction is to protect what's left by getting out. It feels responsible in the moment. But research on trading behavior consistently shows a pattern. Investors who try to jump in and out based on how the market feels tend to miss the specific days when the market recovers most sharply, because those recovery days often arrive without warning, right in the middle of the uncertainty. Miss enough of those days and you can hand back a huge share of your long-term gains, even if you were right that things looked scary at the time. The uncomfortable truth is that staying invested through the drop is usually what separates people who build wealth from people who just trade a lot and end up roughly where they started. Mistake number 2 is quieter, but just as damaging over time: fees you don't notice. Every fund charges something called an expense ratio, a small percentage taken automatically each year to run the fund. A fee that looks tiny, say 1%, sounds harmless, but on a large balance over decades, that percentage compounds against you the same way returns compound for you. The good news is, this is the easiest mistake to avoid entirely, because low-cost, broad market index funds exist with expense ratios a fraction of that size. You're not being asked to accept lower quality for a lower fee. You're just being asked to stop overpaying for something you can get cheaply. So let's put the whole sequence together, because this is the part that actually matters if you're starting from nothing. First, handle high-interest debt, because it's a guaranteed cost working against you. Second, build a cash buffer, so you're never forced to sell at the wrong time. Third, once those are in place, put new money into a low-cost, broad market index fund on a consistent schedule, not as a one-time event, but as a recurring habit. Fourth, once it's invested, the hardest and most important skill is doing almost nothing, not checking daily, not reacting to headlines, letting the two growth engines, business value and compounding, do the slow, unglamorous work over years, not weeks. None of this requires predicting the future. It doesn't require picking the right company at the right time, or timing your entry perfectly, or having a large sum to begin with. It requires getting the order of operations right, choosing something broad instead of something you're guessing about, and then giving it enough time to actually work. That's not a hack. That's just the process, done correctly, before anyone tries to make it more complicated than it needs to be.